You know those companies that are sort of quietly building the future, piece by piece, material by material? Today we're taking a deep dive into one such player, SG Mart Ltd. Our mission here is to unpack their latest Q1 FY26 financials, look at the strategic shifts happening, and figure out how they're using that big capital infusion they got. It's kind of an interesting contract, isn't it? They're dealing with what management called a muted quarter for the industry,
Yeah,
but at the same time, they're making these big strategic moves and, well, showing pretty strong financial health in key areas.
absolutely. And to help us connect those dots, we've gathered the key documents, the quarterly report, earnings presentation, the board meeting minutes, and also that crucial monitoring agency report on their preferential share issue. We'll try to piece it all together for you. The goal really is to understand not just what happened, but what these numbers and decisions actually mean for SG Mart going forward and India's, well, very dynamic construction materials market.
Okay, let's jump right in. Headline numbers for the quarter ended June 30th, 2025. Revenue came in at Rs 11.4 billion. Now, how does that compare? Well, it's up 1% year over year from Q1 FY25, which, okay, sounds all right. But it's actually down 28% compared to the previous quarter, Q4 FY25.
Right, a pretty significant sequential drop.
Yeah. But then you look at net profit, the PAT, that was Rs 323 million. And that's up a healthy 23% year over year, even though it dipped slightly, like 3% from the last quarter. So revenue down quarter on quarter, but profit up year on year and margins improving. It's more than just a mixed bag. It points to some real discipline, doesn't it?
It really does. And the management commentary gives us context. Mr. Shiv Bansal noted Q1 FY26 was, and I quote, a muted quarter for the steel industry overall.
Yeah.
He mentioned macroeconomic headwinds, moderated infrastructure spending, and those fluctuating raw material prices. So that helps explain the sequential revenue dip.
Okay, that makes sense for the revenue side.
But what's fascinating, as you pointed out, is how they still managed to grow net profit year on year and boost their business EBITDA margin. It hit 3.1%. That's up 96 basis points from last year, and importantly, 138 basis points from the previous quarter. That really signals a strong focus on operational efficiency, squeezing more profit out of each sale, even when overall sales were softer sequentially.
Almost a 1.5 improvement quarter on quarter. Wow.
Exactly. And just to add, their cash profit was also strong. 340 million, up 28% year over year, shows the underlying cash generation ability remained robust.
That's incredible performance on the margin front. Okay, so those Q1 numbers show resilience, definitely. But often a company's real strength, especially in tougher markets, lies deeper, in cash management, working capital. And here's where SG Mart looks particularly strong this quarter. Let's unpack their working capital and cash position.
Yeah, this is often overlooked, but so crucial in this kind of B2B materials business.
Right? Look at their net working capital days. They slashed it down to just 15 days in Q1 FY26. That's down from 30 days for the full year FY25. I mean, having your working capital cycle, that's a huge efficiency gain.
Huge. It means cash isn't tied up unnecessarily in inventory or receivables for as long.
Exactly. And then operating cash flow. A really remarkable positive swing. They generated Rs 3,321 million in operating cash in Q1 FY26 alone. Compare that to the entire previous fiscal year, FY25, where they actually had negative operating cash flow of about Rs 2.9 billion.
That turnaround is significant, generating strong positive cash flow from operations, especially when the market is supposedly muted.
It really stands out. And all this results in a very healthy net cash position. Rs 10.2 billion on the books as of June 30th.
So if you connect these dots, improving working capital so dramatically, generating billions in operating cash, it's not just good financial housekeeping. It suggests really robust internal controls and the ability to convert sales into actual cash very efficiently, even in a tough environment. This builds a strong war chest, as you said. It gives them flexibility, firepower for expansion, or maybe even acquisitions down the line.
Makes sense.
And we should probably also mention their ROCE, return on capital employed, was around 21%, and ROE, return on equity, at 10%. Decent returns.
Okay, so strong financials providing a solid base. Let's broaden out to their strategy. SG Mart positions itself as this rapidly growing B2B construction materials marketplace. They've got a massive range of over 48 product categories, more than 4,000 SKUs, everything from construction steel, TMT bars, tiles, cement, and now, interestingly, even solar mounting structures.
Right, diversifying quite a bit.
Yeah. And they frame this strategy against India's big economic goals, right? The push towards a U.S. $10 trillion economy by FY32, manufacturing growing its GDP share, the huge $2 trillion B2B market that's currently very fragmented. SG Mart says they want to be an emerging trading hub to kind of consolidate and serve this fragmented market, like the big trading houses you see elsewhere.
Yeah, like in Japan or Germany, those large trading conglomerates, it's an ambitious goal. It implies moving beyond just being a simple marketplace. It's about adding value across the chain: logistics, financing, quality assurance, risk management, becoming that central trusted player in a complex market.
So how are they building towards that? What are the core business verticals doing?
Okay, let's break it down. They have four main verticals. First, B2B metal trading. As we discussed, revenue and volume were down quarter on quarter in Q1, reflecting that softer steel market. Second, their network of service centers. This seems like a key strategic pillar for physical presence and value add. They have 5 operational now, plan to add 5-7 more each year, aiming for pan-India reach. And interestingly, they mentioned an upcoming presence in Dubai, looking to leverage global trade dynamics.
Dubai, okay. Global ambitions too.
Seems so. Their current capacity is about 80,000 tons a month across these centers. Revenue and volume here also dipped slightly QoQ, but the expansion plan shows long-term commitment. Third, downstream distribution products. Here, interestingly, revenue actually increased quarter on quarter.
Oh, that bucks the trend.
It does. It might suggest stronger demand for certain finished goods or maybe better pricing power in that segment, shows the value of diversification. And fourth, the really new and potentially high-growth area, renewable structures. This is focused on solar module mounting structures. Operations just started in April 2025.
Very recent.
Right.
Ferry. But they already have an order book of Rs 283 crore as of June 30th. That's quite significant for a new venture. They're targeting a capacity of 15,000 tons per month by the second half of this fiscal year, leveraging existing infrastructure. And it's already started adding to the top line, or 67 million in revenue this quarter.
So that renewables play is already contributing. That's fast.
It is. And one other thing to note is that shift they made back in Q4 FY25 for TMT products, moving to a royalty-based model. Royalty revenue actually increased this quarter. So that seems to be working, shifting towards potentially higher margin income streams for certain products.
Right, focusing on value, not just volume everywhere. Okay, these expansions, especially into renewables, obviously need capital. Which brings us to that huge preferential issue, Rs 1,150 crore, allotted back in November 2023. So the big question for you, the listener, is, where did all that money go? Have they actually used it as promised? A very important question. And that's where the monitoring agency report from Care Ratings comes in. They're tasked with tracking the fund utilization. According to their report for the quarter ending June 30th, 2025, the full Rs 11,150 crore has been received by the company. And as of that date, Rs 1,132.47 crore has been utilized.
Okay, so almost all of it. How is it used? Did it match the plan?
Largely, yes. The report breaks it down. Rs 882.47 crore went into working capital needs. The plan was for Rs 900 crore, so pretty close. And Rs 250 crore was used for general corporate purposes, exactly as proposed in the issue documents.
And what about funds raised more recently, like from warrants?
Good point. In Q1 FY26 specifically, they received Rs 255.34 crore from the conversion of warrants. Remember, warrants give investors the right to buy shares later, so their conversion brings in fresh cash and signals confidence. Of that amount, Rs 5.34 crore was used for working capital, and the remaining Rs 250 crore went towards those general corporate purposes. The report specifically mentions it was mainly used to clear an outstanding HDFC overdraft balance.
Okay, clearing debt. And the unutilized bit?
A small amount left Rs 17.53 crore. It's currently parked safely in a fixed deposit with HDFC Bank, maturing December 1st, 2025, and earning 7.60%. So the bottom line from Care Ratings is clear. Nil deviation from the objects of the issue.
A clean bill of health from the monitor.
Yes, based on the information provided by SG Mart. It's important context, as the agency relies on the company's data and doesn't conduct a full audit itself, but it provides crucial transparency.
Absolutely. Okay, shifting gears slightly. Beyond finances and capital, that board meeting on July 25th also had some interesting corporate governance points. Leadership changes, employee incentives.
Right, some significant moves there. First, leadership. Shri Arun Ograwal was appointed as a non-executive director. His background is notable: chartered accountant, over 20 years in finance, operations, strategy, including key roles at Apollo Pipes and APL Apollo Tubes. So deep experience in related sectors.
That sounds like a strong addition to the board.
It does. At the same time, though, Shri Shiv Kumar Bansal, who was the joint managing director, resigned effective July 31st, citing personal reasons. The board thanked him for his contributions. Now, leadership changes, especially at the joint MD level, always get attention.
Yeah, personal reasons can mean many things. How significant might this be?
It's hard to say definitively from the outside, of course, but for a company aiming for rapid growth, stability at the top is generally preferred. The key will be how smoothly the transition happens and how well the existing team, perhaps bolstered by Mr. Agrawal's strategic input, executes going forward. It's something to watch.
Definitely. And what about the employee incentives?
The board approved two things there. First, repricing some unexercised stock options from an older 2023 plan. Second, and more importantly, they instituted a completely new plan, the SG Mart Employees Stock Option Plan 2025. This new ESOP allocates up to 2 million equity shares managed via a trust for eligible employees.
So doubling down on stock options.
It seems like a clear move to attract, retain, and motivate talent, aligning employee interests with shareholder value creation, essential for growth plans. They also recommended appointing Ms. Parikh and Associates as secretarial auditors for the next 5 years, which is standard governance practice.
Okay, so bringing it all together, what's the key takeaway for you listening to all this? SG Mart navigated a tricky quarter with, frankly, impressive resilience, especially on margins and cash flow. Working capital management looks sharp. They're deploying that big chunk of capital from the preferential issue pretty much as planned and making strategic bets on expansion in new areas like renewables. Plus, they're tweaking leadership and boosting employee incentives, all while aiming for that ambitious 50% CAGR target over the next 3 years. They clearly want a big piece of India's infrastructure story.
Absolutely. SG Mart's quarter really highlights that complex balancing act, managing the immediate market pressures while investing heavily for long-term ambitious growth. The leadership transition adds an interesting dynamic alongside the push into new verticals like renewables. So maybe a final thought for you to consider is this. How effectively can SG Mart integrate this new board-level expertise and execute flawlessly on these diverse growth fronts, the service centers, the renewables push simultaneously? What potential hurdles might they face in scaling these new ventures while maintaining that impressive financial discipline we saw this quarter, especially as they aim to become a dominant B2B trading hub in the coming years?